wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 194, and in this episode we're reviewing the performance of the financial markets during the first full week of 2026, and that is from Monday the 5th to Friday the 9th of January. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where according to the Bureau of Labor Statistics, the U.S. labor market ended 2025 on a soft note, with job creation in the month of December coming out slightly lower than expected. Non-farm payrolls rose by a seasonally adjusted 50,000 jobs in December, which was lower than the downwardly revised number of 56,000 in November and short of the Dow Jones estimate for 73,000 new jobs. At the same time, the unemployment rate fell to 4.4% compared to the forecast rate of 4.5%. The report presented a mixed picture of the labor market, with companies reporting low levels of hiring, whilst households showed employment gains. According to the Bureau of Labor Statistics, for the full year 2025, non-farm payrolls averaged about 49,000 jobs a month, compared with 168,000 jobs in 2024. In a social media post on Thursday evening, President Trump indirectly revealed data about the non-farm payrolls, which was due out on Friday. This was a violation of federal policy on statistical releases. The Office of Management and Budget Policy prohibits the executive branch from commenting on such data prior to the official release. And even after the release, the office also forbids any public statements until 30 minutes after the data has been released. Staying in the United States, earlier in the week, the Federal Reserve on Tuesday released minutes of its highly divisive meeting in December, which concluded with a vote to lower interest rates for the third time in 2025. According to the summary, Federal Reserve officials expressed a variety of opinions during the December policy meeting. Ultimately, the Federal Open Market Committee approved a 0.25 percentage point rate cut by a vote of 9-3, as officials debated the need to support the U.S. labor market against concerns about inflation. The rate cut in December lowered the Fed funds rate to a range of between 3.5% and 3.75%. On Wall Street this past week, the S&P 500 rose to new highs on Friday and recorded a weekly gain following the release of the latest jobs data for the month of December. The December jobs report showed that non-farm payrolls increased by 50,000, which was slightly weaker than expected, but still showed a U.S. economy that is growing steadily and which is expected to up the pace later in the year. The jobs report suggests that the Federal Reserve may not need to cut interest rates at its first two policy meetings, which are slated for January and March 2026. All the three major averages posted a winning week, with the S&P 500 rising more than 1% during the week before closing at a fresh record high of 6,966. Meanwhile, the Dow Jones Industrial Average jumped by 2.3%, scoring a new closing record at 49,504. And last but not least, the tech-heavy Nasdaq Composite gained by 1.9% during the week before settling at 23,671. In the government bond market, the yield on the benchmark 10-year Treasury bond dipped on Friday after the latest jobs report showed a mixed picture of the U.S. labor market. The December jobs report showed a stable but softening labor market that may lead the Federal Reserve to consider cutting interest rates, perhaps as early as the second quarter of 2026. According to the CME's Fed Watch tool, the Fed Fund futures are pricing in about a 32% likelihood for at least two rate cuts of 25 basis points each before the end of this year. The yield on the 2-year Treasury note was up by more than 4 basis points at 3.53%, whilst the yield on the 10-year Treasury bond was down by more than 1 basis point at 4.16%. In related news, mortgage rates fell sharply on Friday after President Trump posted on social media that mortgage companies Fannie Mae and Freddie Mac should buy $200 billion in mortgage bonds. In response, the rate on the 30-year mortgage dropped by 22 basis points to settle at 5.99%. For your information, whilst Fannie Mae and Freddie Mac do not originate any home loans, they are government institutions that help to keep mortgage rates low and stable for home buyers. And they do so by buying loans from lenders and bundling them into mortgage-backed securities, which they sell to investors, thereby replenishing funds for new loans. And again, just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil rose on Friday, driven by concerns about potential disruption to Iran's output and uncertainty about supply from Venezuela. Civil unrest in Iran seems to be gathering momentum, leading to concerns about disruption of oil supply. Meanwhile, on Friday afternoon, President Trump met with more than a dozen oil companies to discuss plans for investment in Venezuela after the U.S. ousted President Nicolas Maduro. President Trump said that the U.S. will control Venezuela's oil sales and revenue for an indefinite period. He also said that U.S. oil companies will spend at least $100 billion in order to rebuild Venezuela's energy sector, and in exchange, the U.S. government will provide security and protection. Both benchmarks were up for the week, with Brent crude rising by 2.8% before coming to a close at $63.44 per barrel. Meanwhile, the U.S. benchmark, that is West Texas Intermediate crude, gained by 1.5% during the week before settling at $59.24 per barrel. In the precious metals market, the price of gold rose on Friday and was on track for a weekly gain as investors weighed the weaker than expected U.S. payrolls data alongside broader policy and geopolitical uncertainty. Market participants continued to factor in at least 2 rate cuts by the Federal Reserve this year, a move that is favorable for gold given that it doesn't pay out a regular yield like a bond. Geopolitical tensions remained elevated amid intensifying civil unrest in Iran, the continued conflict between Russia and Ukraine, the recent capture of Venezuela's president, and the takeover of its oil industry by the U.S., and finally, Trump's renewed rhetoric to take over control of Greenland from Denmark. Investors are also watching a potential ruling by the Supreme Court on the president's authority under the International Emergency Economic Powers Act to impose tariffs without congressional approval. A company by the name of Metals Focus has projected that the price of gold could hit a fresh record high above $5,000 in 2026, driven by the trend towards de-dollarization and geopolitical risks. For your information, de-dollarization refers to the process by which countries are reducing their reliance on the US dollar as the primary currency for international trade and also as a reserve asset. In closing, the price of spot gold was on track for a weekly gain of 3.9% as it eventually came to a close at $4,496 per ounce. In the cryptocurrency market, 2025 was supposed to be the year for crypto. Starting with the re-election of President Trump, who promised to make the United States the crypto capital of the world, and he delivered on that promise by appointing crypto-friendly regulators and by passing major legislation which has provided clarity and allowed crypto to become more closely integrated into the U.S. financial system. The total market value of the crypto industry approached $4 trillion in the third quarter of 2025 as the price of Bitcoin hit an all-time high of $126,000, driven by demand for Bitcoin ETFs. Crypto gained a lot of traction in 2025, and that was mainly driven by asset managers who expanded options for institutional investors to invest in crypto through the use of exchange-traded funds, which is a collective investment vehicle that provides exposure to a particular asset, which in this case would be crypto. However, in the fourth quarter of 2025, more than $1 trillion in market value was erased from the crypto market as the price of Bitcoin fell nearly 30% from its peak to below $90,000 per coin. According to market analysts, there are 3 major forces that drove the crypto market in 2025. The first was the normalization of crypto ETFs, the second was the rise of institutional investors, and the third was the tightening link between crypto and macro policy as well as liquidity. We now change scene to the Kenyan financial markets, And we start by looking at the Kenyan economy, where data shows that the Kenyan economy grew by 4.9% in the third quarter of 2025, which was an improvement from 4.2% in the third quarter of 2024. The industrial sector rebounded strongly in the third quarter, expanding by 4.8% compared to a contraction of negative 0.4% for the same period in 2024. The services sector maintained robust growth of 5.5%, whilst the mainstay of the economy, which is the agricultural sector, grew by 3.2% in the third quarter of 2025. Kenya's economy is set to expand at a faster rate in 2026 as inflation remains stable, reflecting a recovery that will test the balance between growth and the cost of living. According to the latest economic update on Kenya from the World Bank, inflation is expected to hold steady at around 5% in 2026, whilst the economy is projected to expand by 4.9% in 2026, indicating a gradual strengthening of economic activity. And looking at the cost of living in Kenya, data from the Kenya National Bureau of Statistics shows that food inflation was the biggest contributor to the overall rate of inflation in the month of December. According to the Bureau, inflation as measured by the Consumer Price Index was recorded at 4.5% in December, which remained unchanged from November. Kenya's inflation rate has remained below 5% since July 2025, supported by a stable shilling and previously high interest rates, which constrained both credit growth and consumption. The shilling has stabilized at around 129 shillings to the US dollar for the most of 2025, helping to ease the cost of imported goods such as fuel oil. Moving on swiftly to the domestic foreign exchange market, where the Kenya shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 128.99 compared to 129 flat the previous week. Meanwhile, the sterling pound was priced at 174.04 and the euro was valued at 150.84. And on the regional front, one Kenya shilling was changing hands for 27.93 Ugandan shillings and 19.19 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.30. The IMF has raised concerns about the extreme stability of the Kenya shilling, but the central bank insists that it continues to operate a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined marginally by just $10 million for a grand total of $12.38 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was sufficiently liquid and the central bank remained active in the market through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as a Kenya shilling overnight interbank average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.97%, down from 8.99% the previous week, but still pretty much in line with the new central bank rate at 9% flat. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is set at 3.25%, this amount stood at 13.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 8th of January, and the central bank received bids totaling to 31.2 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 130%. The central bank ended up accepting 26.1 billion shillings, and the results of the auction were as follows. The 91-day rate was steady at 7.72%, whilst the 182-day rate was flat at 7.80%, and the 364-day rate remained unchanged at 9.20%. In the primary bond market, the auction for the monthly Treasury bond issuance was held on Wednesday, the 7th of January, and the central bank received bids totaling to 71.5 billion shillings against an advertised amount of 60 billion shillings, representing a performance rate of 119%. The central bank ended up accepting 60.5 billion shillings, and the results of the auction were as follows. For the first bond, which is a 20-year bond that was initially issued in 2019 and now has 13.2 years left to maturity, the central bank accepted 20.2 billion shillings at a weighted average rate of 13.26% compared to the bond's coupon rate at 12.87%. And for the second bond, which is a 25-year bond that was initially issued in 2022 and now has 21.8 years left to maturity, the central bank accepted 40.3 billion shillings at a weighted average rate of 13.75% compared to the bond's coupon rate at 14.18%. Up next is our topical issue, and this week we're looking at the introduction of a new tax on remittances from the United States. The introduction of a new remittance tax by the United States is likely to derail the inflow of diaspora remittances to Kenya in 2026, disrupting what has become an increasingly important source of foreign exchange. The United States, which is Kenya's largest source of remittances, has introduced a 1% excise tax on money remittances, effectively raising the cost of sending money back home from the 1st of January 2026. The new tax could reduce both the size and the frequency of remittances flowing back to Kenya. Analysts have projected that even with certain exemptions, the tax could reduce remittances from the United States by at least 1.6%, triggering knock-on effects such as lower household incomes and increased foreign exchange pressure in the domestic foreign exchange market. The cost of remittances, which is mainly driven by fees and currency conversion, has long been a global concern due to the impact on families, especially in the emerging markets. The levy on remittances could skim billions of dollars from migrant workers, many of whom already pay taxes in the States. The money remitted to Kenya isn't just extra cash. In some cases, it's the only source of income that is used to put food on the table and pay school fees for millions of households in Kenya. The cumulative inflow of remittances to Kenya for the 12 months to November 2025 increased to $5.04 billion. The inflow of remittances remains a major source of foreign exchange earnings and continues to support the balance of payments as well as the domestic foreign exchange market. The United States accounts for more than 50% of the total diaspora remittances into Kenya. The big question moving forward is whether Kenyans in the diaspora will find alternative ways to remit money, or they will reduce the amount of money that they send back home. As usual, we will keep a close eye on diaspora remittances for the first few months of 2026 in order to determine if and how this new tax will impact the flow of diaspora remittances into Kenya. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhurigi@gmail.com. Jamhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, never let success go to your head, and never let failure get to your heart. Think about it. Thank you, and God bless.